In this video, I'll compare multiples valuation techniques using entity multiples and stock price multiples. Now, some of the company characteristics that enter into a company's value might very well be earnings per share, EBITDA per share, sales per share, free cash flow per share. And then some other company characteristics that would impact a company's value might be sales growth, capital intensity ratio, capital structure, debt to equity ratios, things like that. All of these characteristics are characteristics that could impact a company's value and in all likelihood will impact a company's value. And cross-sectionally, it can impact the way multiples analysis works. Now, not all of these measures, at least of those top several, are used intelligently by analysts. The way that these are used are typically you take a price, and then you divide it by whatever X is, whatever that relationship is, and calculate, for example, a price to earnings ratio, or backing up a little bit, price to earnings per share, so price to earnings ratio, or perhaps, we'll talk about this in a minute, a price to EBITDA ratio, or the price to sales ratio, or perhaps a price to free cash flow ratio. But not all of those ratios actually make sense. Specifically, when you're calculating a price to something ratio, it needs to be the case that the X, the something, needs to be related to the per share price if we're going to use price as the numerator on that. Otherwise, it might be that it needs to be related to the entity value or the entire value of the company, and I'll explain how that works in just a second here. So, for example, let's look all the way down at the bottom, down here, and look at net income or earnings, earnings per share or total earnings. Since earnings per share is a residual cash flow, it's what's left over for stockholders, then it makes sense that net income or earnings per share ought to be used in a stock price ratio. So you would use, for example, PE, price to earnings ratio, where P is the per share price and E is earnings per share. On the other hand, if you move up a little bit, for example, under operating profit or EBIT, notice what happens with this value here. This operating profit or EBIT is used to pay interest expense, so it's used to pay bondholders, and that leaves us profit before taxes and taxes, and then it leaves us residual earnings. And so this EBIT is a cash flow that's available for both stockholders and bondholders, and so consequently, you wouldn't use EBIT to measure an individual stock price. Rather, you'd use EBIT to measure the entire value of a company. So you wouldn't do a price to EBIT ratio. You'd use an enterprise value to EBIT ratio. Similarly, EBITDA is just another one that you could look at. And EBITDA, notice depreciation and amortization come out, then interest expense, and then you have the residual for shareholders. And so EBITDA would be best used as an enterprise to EBITDA ratio, not a price to EBITDA ratio. And then finally, up here at the top, clearly sales, you use sales. From that you pay costs, various costs. But then afterwards, you keep on going down out of sales, and after you take out costs, you have interest expense, which goes to bondholders. And then what's left over is the residual. And so this sales figure goes to satisfying both the bondholders and the stockholders. And so consequently, a price to sales ratio would not be an appropriate measure. You'd want enterprise value to sales, because sales goes to pay both stockholders and bondholders. Now, if we look at balance sheet ratios as well, we can have the same thing. So, for example, down here under shareholders' equity, that's the book value of shareholders' equity. Then, since that is shareholders' equity's amount, then you would use a market to book ratio, which would be the market value of stock divided by the book value per share. And that would be an appropriate kind of ratio. But it wouldn't be appropriate, for example, to have market value of stock to total assets, because total assets is since the balance sheet balances total liabilities and equity, both debt and equity. So instead, you would want enterprise value to total assets, not price to total assets. So the way this works is that if you're using an equity multiple, so for example, we talked about price earnings ratio. The price earnings ratio is an equity multiple, and so the way you use it is you take that multiple. For example, an industry average might be 26.35. This was an industrials average. Multiply it by a company's earnings per share, say $8.84, and that would give us a PE-based estimate of the stock price of industry multiple, 26.35, multiplied by the company's earnings per share to give you an equity multiple based estimate of the stock price of $232.93. So that's how you would use an equity multiple. The end result of using an equity multiple is the company's projected stock price. Now, if you use an entity multiple, it's a little bit different. Here, you're going to try to value or get an estimate of the value of the total company, which is the value of its equity and the value of its debt. And so an example of an entity multiple is EBITDA. And so in EBITDA, using an EBITDA ratio, you would take an industry average of EV, enterprise value, to EBITDA, and say that average is 11. Multiply it by the company's EBITDA, say $50 million. And so enterprise value to EBITDA of 11 multiplied by $50 million would give us a measure of the company's multiple estimate of entity value of, in this case, $50 million multiplied by the industry average of 11, or $550 million. That would be the company's debt and equity together, its enterprise value. Now, the way that you use this to find equity value is that we recognize that the enterprise value of the company is the debt plus equity. We already know that's estimated to be $550 million. If the company has $100 million in debt, then our estimate of the value of equity, and this is an estimate of the market value of the equity, not of the book value. So the estimated market value of equity is that enterprise value that we projected or estimated minus the debt. 550 minus the 100 gives you $450 million. If you want to find an estimate on a per share basis of the equity value, we divide by the number of shares outstanding. So in this case, if we've got 20 million shares outstanding, then the projected price would be $450 over 20, or $22.50. So that's how you would use an entity multiple to figure out a projection or an estimate of a company's stock price. Now, in order to use entity-based multiples or even price-based multiples, you need to have some sort of source of this on an industry basis. And one source is Reuters, www.reuters.com. It's a little bit hard to find, but go to the Markets tab, then pull up the U.S. Markets tab over to the right, enter the ticker symbol, and click on Financials and scroll down. And what that's going to do is it's going to give you a variety of multiples for the industry that company is in. Then you can use that industry's multiples in order to estimate values for other companies that are not the one that you were looking at. Because, of course, this web-based source is only, Reuters is only going to give you publicly traded companies. Now, some of the ratios that are available on Reuters, some of them are ones you would expect, and then some of them are perhaps not exactly the way they ought to be. As we talked about price to earnings ratios, we use that a PE ratio, price to earnings, and TTM means trailing 12 months because, of course, we've got the current price and we don't know what next year's earnings are going to be. We just have an estimate of that if we used analyst forecasts, but we do know what the last 12 months of earnings are. So TTM just means they're using the last 12 months of earnings. There is a price to sales ratio on Reuters, but I'll argue that the price to sales ratio is an inappropriate ratio. You shouldn't be calculating that because that's price per share to sales per share, and sales is not an equity-based measure. It ought to be an enterprise value-based measure. And so rather than a price to sales ratio, Reuters ought to be providing an enterprise value to sales ratio, but that's also a trailing 12-month figure because sales is the last 12 months. Price to book value of equity, MRQ, means most recent quarter. So book value is measured as of the most recent quarter. I'll talk about tangible book in just a second, but that's also most recent quarter, and those make sense if provided tangible book is tangible book value of equity. And this book is also book value of equity. Price to cash flow. Now, this is an interesting one. In Reuters, cash flow is the operating cash flow, not free cash flow. So you have to be careful about what cash flow you're using. Operating cash flow is based on net income, and it's not free cash flow, and it would be a stock price measure because it's related to net income, not to free cash flow. Tangible book is total assets less intangibles, or alternately book value of equity less intangibles. And if it's calculated as total assets less intangibles, then price to tangible book really ought to be enterprise value to tangible book. But as I discuss on the next slide, Reuters uses tangible book as book value of equity less intangibles. So let's look at that in just a second here. So a digression on tangible book value is that some sources actually define tangible book value to be total assets less intangibles, and that's fine. It's just you need to be careful which definition you're using, and that would be a useful measure for entity valuation because it has both debt and equity components. Other sources like Reuters define it as book value of equity less intangibles, and if that's the case, then it's a useful measure for stock valuation, for a stock multiple. And so in the case of Reuters, price to tangible book, it's okay to have the per share price to tangible book value per share. There we go. Now, some other ratios that would be useful if you could get them, and we don't really have those available, at least on Reuters, is enterprise value to free cash flow, and partly because free cash flow is very rarely reported in any useful websites, but that would be very useful. Enterprise value to EBITDA, that would be a useful ratio that could be reported as well. And EBITDA, just so that you know, that's earnings before interest, taxes, depreciation, and amortization, and you calculate it by adding back depreciation and amortization to EBIT. And it's just another way of looking at a cash flow measure. Now, it turns out that these enterprise values, which would be and are useful for valuation, they're not maintained on very many websites, but Aswath Damodaran at New York University, who does a number of really good things for the finance community, one of which is maintaining a market risk premium calculation on a monthly basis. So he really does provide good services for the finance community as a whole. Also maintains some data on enterprise multiples, and he updates them periodically as well. And some of here's the website for them. Some of the enterprise value multiples that he maintains would be, for example, enterprise value to EBITDA. So that would be total enterprise value. He would look at an industry, look at the total equity, look at the total debt, divided by EBITDA, and then average it for the retail industry, and that would be 9.47. He also has an enterprise value to EBIT ratio, and for the retail industry, that works out to be 17.42. And so that would be a way of using an enterprise value multiple for valuing another company that didn't happen to be publicly traded.